So when we're looking at price action, and you've probably seen enough of it over the last couple weeks now, there's a lot of different approaches that trading can give you for a model approach. What style of trade you're going to be? You're going to be a day trader. You're going to be a scalper. Or you're going to trade the entire daily range. You're going to be a short-term trader. You're going to hold overnight or over the weekend. Or you're going to be a swing trader and hold for a couple weeks. Which right now, that would be extremely ballsy. Like that. I mean, there's there's a lot of gap risk. You have no idea what's going to cause an extreme gap. We might have an extreme gap on Sunday tomorrow. Like we may see it open up way, 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 way far away from where we closed on Friday. Why? Well, we got that big liquidity pool resting below that. We have the liquidity pool above those relative equal highs in that volume of balance on the daily chart for dollar. So they could start the week right up there. And then that makes the rest of the week a little bit more challenging because it could open up there for dollar and then trade back down to where we closed on Friday, consolidate around a little bit, and then it has to wrestle and go back up through that again to continue higher if it's where it's going to go. So what I do on the weekends, and this is what I've been doing now since 2020, is I'm basically watching the headlines and seeing what's happening around the world. And when we look at charts daily, it's my hope that you're learning to see how these things come to fruition, the organization of how they form in price action. When I call something out on Twitter in tweets saying, okay, look at this, look at that, the real students can hear me say when I'm really expecting the price run in a specific direction where I think it's going to go, that type of thing. And they're the ones I'm trading. They're the ones you see examples later on. And it's not ambiguous. It's very specific. We're not calling buys and sells every single time I mention something, but I'm bringing your attention to a specific PD array. If I talk about a fair value gap, most of the time when you hear me mention fair value gap, a new student that's never really spent the last 2 weeks with me, they'll think, okay, well, he thinks it's a buy because right now we're above it. That doesn't mean what I'm saying that at all. I'm saying that that's why we're watching that next. And if it can go through that, I may be bearish. I'm building the idea that I'm thinking the market's likely to go lower longer term. And I'm going to watch that fair value gap that would be below price. What would that be indicative of? I want to see it lose ground. I don't want to see it respected at all. Someone is looking at these things and saying, okay, what is he taking my attention to for? Because he's looking at this fair value gap, but he's also talking about how it could go down to a specific level. So it would seem confusing to a new trader or new student or new observer, but it's not to someone that's been watching me. If you've been in the live sessions also on YouTube, you can see how I talk about how I want to see it go through this fair value gap and then come back down into it and act as what? Support if I'm bullish. I want to see certain things unfold. That is narrative. Like I don't know how to write a chapter. I don't know how to send a bunch of tweets. I can't tell you audibly like this. Like you got to watch me do it. That's the only way I can describe it. I don't, very difficult for me to explain something that needs to be viewed real time, watching it happen and explaining why this is the case. What many of you ask a lot is, well, how do you know, which one it's going to form today? That's the uncertainty. Like you see these people out there, they'll say, oh yeah, ICT says he knows about the algorithm, but he doesn't know this right at this moment. You're right. I don't know where they're going to open the price up on Sunday. Nobody knows that. If it's going to run off and leave it. I don't know if there's going to be a breaker. I don't know that. It might be just these one pass down and straight up and no opportunity for a breaker to form. Those are the things that I don't know. I don't know that. Those things I have to wait for, just like you have to wait for. The idea of these funded accounts and the 5 handle moves and such, I see a lot of you are getting confident with that now, and I appreciate. And when you have these competitions for everyone's attention, and you're trying to inspire them to go out there and trade, unfortunately, I know enough to know that the average person doesn't have the mental faculties to do this, let alone be doing it quickly and successfully, regardless of what medium or approach to trading. Even mine, you want a routine on how to go in and do those things. That's exactly what I'm teaching you this year. a day in and day out. This is what we're looking for. This is what it looks like. This is how it repeats. And we aren't afraid of signals drying up and not working anymore. And they send me emails. They'll say things in the comment section. I tried the optimal trade entry and I get stopped out. How do you know which one's the optimal trade entry? Well, what are you doing wrong? Looking through the looking glass, you're looking for entries only. You have no context as to what you're doing. There's no narrative being applied to the chart. You haven't even consulted the higher time frame. So is it surprising why you're looking at something on the smallest degree of importance, which is the entry? I've stated this so many times that it's almost like you guys don't want to believe me when I'm being honest. Entry patterns are numerous. There's so many entry techniques to get you into the moves, but there's only one side of the narrative that's going to develop in price. That's it. You're not going to change that. The buying, selling, and pressure doesn't change it. The narrative is going to unfold, and that's just the way it is. And if you're not able to get on side with that, that means get in alignment, get in sync with it. Any entry techniques, I can give you the best ones I have. What makes this market most likely to go higher, and where the hell is it going? Just because you think it's going up, where's it going to? Because if you don't know that, you're going to overstay your welcome or exit far too soon. And if you look at what I'm teaching and how I teach it, I'm teaching you when to time the market, when to build a model that is bullish, when the bearish model is expected, when the market's going to be in consolidation and try not to be expanding with your expanding, but entering with your trades, expecting the market to expand out of that range because it's most likely to do what? Consolidate ahead of a big report. So you're not gonna be guessing. Once you experience loss, one of the best things that could ever happen is for you to experience losing an account. What do you say? Yeah, that's the worst. That's the worst thing in your mind that could ever happen right now as a student, right? That's the worst thing. How could anybody say that's the best thing? Because you'll know what it feels like to have one moment where you didn't even see it coming, and then boom, you don't have anything in the account, at least not enough to take another trade. I think every trader needs to experience that because then you'll respect the risk. What happens if you do blow an account, but you don't respect the risk and you go out there and you just do the same thing with the second one? Here's what you're not observing. What you're seeing in that, but ignoring, is that you are impulsive and a gambler. And that means you have to do some work. You have to correct that. And it's not easy because you are the person that's driving that. And you're doing it recklessly because you need an outside of you confirmation. That's why you're doing it. You're trying to do something Olympic sized, over leveraging an account, trying to get some kind of big win so that way you can feel like you are formidable. You can make a lot of money. Look at this. This makes you a good trader. No, it doesn't. It does not make you a good trader. It makes you an impulsive gambler. And guess what? Sometimes impulsive gamblers go to casinos and make a lot of money. But impulsive gamblers don't go to casinos every day or every week or every month of the year and make lots of money. Professional gamblers are not impulsive gamblers. They're calculated money managers, and they're utilizing the cards as what? Their multiplier. They don't know what the next turn on that card is going to be. They don't know what hand's going to be given to them. They don't know. And they embrace that uncertainty, which is the equivalent of us doing what in trading? We don't know what that next candle is going to do. They could drop a bomb somewhere and boom, the market gaps completely outside what your chart's showing, especially some of you, what I was talking about today in the lecture this morning. You're so zoomed in and you had just a handful of candlesticks. Like it's only going to move 10 handles at most. Like you have to have some data on your chart. That's the reason why you're not holding your trades as long, because you have no visibility. You're too close to the forest or too close to the trees to see the forest. You have your nose on one tree, and the only thing you can see is that bark on that one tree. That's exactly what every YouTuber is doing. There isn't one YouTuber out there that I've seen that has enough data on their chart to make balanced decisions. You're looking at it too close. And when you do get a winner, I'm in your audience sometimes, and I'm thinking to myself, it would be rude of me to overtake and say, this is what's going to happen. But I have sometimes tossed out numbers that said, like here, like a gentle nudge, like here, look there, and then don't take your profits in the next 5 handles. It's scary. Like I had to overcome a lot just to get into trades in 1992. Like it was scary after my first trade, which I impulsively just jumped in because I had to just do something. I felt like I had to do it. And if I could be honest for a second, and I did that orange juice option, it was almost like that same feeling. Like it felt like it was an overwhelming, I have to do something, and almost like I didn't have any control over it. Like I literally was pushed subconsciously to make a dumb decision. And I know looking backwards at that moment, how it was one of the most reckless and just careless decisions I've ever done with money. Now, I can do that today, but admittedly, that was a dumb decision, which caused me to make a lot of tweaks and mess with stuff and blow accounts trying to make things happen when I didn't have any proof behind what it was I was trying to force as a trader when I first started. And for some, if you listen to me as a benchmark of 5 handles, you're starting from ground zero. So 5 handles is a huge win. But if you just right now, for instance, the folks that are in Africa, you are challenged financially right now. If you made $250 a week, just a week, that's life changing over there. But these 5 handles can make a major dent, even with what I spend a month. So I know that all of you that aren't making a lot of money right now, and you're making whatever your job pays, by conditioning yourself, looking for something that's realistic and practical, 5 handles as a beginning, I think is reasonable. It's easy, in my opinion, but it's also powerful because if you can develop the confidence to see this repeating a lot, and you're not going to be fearful of missing anything. Why? How can you get to the point of ICT never fearing missing a move? Because I see them coming at all angles all the time. There's a lot of them. The point is you have to find the ones that you like. That's not my market. I don't wake up and look at the S&P and say, oh shit, it moved 20 handles overnight. I wish I could. No, I can find 20 handles in a day doing 5 handle runs, up, down, up, down. There's my 20 handles. I'm not worried about it. And you won't be worried about it, which is where you should be as a trader. You need to know what you're looking for, what you're going to accept as a trade that incurs risk, and be comfortable with that. And if it fails, you're not going to lose your mind about it. You're not going to be in a hurry to try to find something that really isn't in the chart. What you're trying to do is impose your will. You're looking through that looking glass in a losing position. You're in drawdown. You're going to manifest your next setup, even when it's not there. Why? Because you don't have a clue what you're doing. You don't know your model, because if you knew your model, you would sit still until it formed. But you have to predict the price. You have to. That's what every winning trader is trying to do. And that's where I live. That's my fast lane. I'm taking you in there doing that. But I also know, as your mentor, that you're going to have problems in the beginning. You're going to discover things about yourself that you are not going to like. And you're going to impulsively, because you're not disciplined, you're not going to have the impulse of a professional where it is, okay, I'm in a market environment right now that is not conducive for high probability. So I'm going to impulsively remove myself because my training tells me to do so, not run away in fear or not roll the dice and see what happens, which is predominantly what everybody does. That's the demo disease. Okay. Push the button and see what happens. Push the button and see what happens. In the beginning, you're going to be a train wreck when you discover what you have as character flaws. Nobody has ever started this industry, ever, ever. Never happened. It's never, ever happened. It's never happened where somebody walked out here, got it all right from day one, and never had hardships or had to wrestle with internal conflicts with what they are as a trader, what they're not as a trader. They don't have a person out there in the industry that's like that. Everybody comes in here and we are all baptized in the fire. And that is going to be pain. It's going to be loss. It's going to be frustration. And guess what, folks? Listen, friends and neighbors, that is absolutely part of this. And that's why I never make any sugarcoating about it. I want you to know that's coming because that way you're prepared to, number one, identify it when it does. And then you have to do certain things to wrestle it and subdue it because it will undo you. I don't go out there and say, go out there and try to go for 10 handles a day. That's unrealistic. I tell you to look for one 5 handle move. That's what you're looking for. In hindsight, by doing that every single day, you're conditioning your eye to see it. They're the two most important, visually pleasing, easy to find. Jump on a chart real quick, any time frame, your eye will go right to the relative equal highs, relative equal lows. And if there's a fair value gap in the middle of it, and you know there's likely to go up there, Well, you can buy the fair value gap and ride it up to the relative equal highs. There's your model right there. It's done. I just gave it to you and it cost you nothing. Probably some of you never even thought about it. You're like, now, oh man, I never thought about it like that. Yes, it's just like that. But when you don't go through old data and you just binge watch my videos and you're not pouring yourself in charts, spending time literally every single day looking through charts, studying how these other moves that you can't make money or lose money in, well, your attention to detail, and the details are what I'm teaching you. These elements, these PD arrays. It doesn't matter which one I love. It doesn't matter which one I'm using today, next week, going forward for the rest of the year. It only matters which one that you like. Which one makes the most sense to you? The first one that you can see easily in the chart, and it might not be the fair value gap. To me, it's the easiest one to see and spot, but it might not be for you. You might see a breaker. It just makes perfect sense to you. And guess what that means? You're going to trade breakers. It doesn't mean it's inferior or superior to any other one. There's so many times traders will ask me, what's your favorite setup? The one I'm getting in, that's the one I like the most. The next trade I'm in, that's the one I love the most. I have lots of them. And I try not to build the case for this is my favorite setups, because as soon as I say that, and when you ask me what my favorite is, I know why you're doing that. It's the same reason why I was wishing I could reach out to Larry Williams and say, which one of these trades would you like doing the most? Me, if you were to ask me that right now, I can tell you what that is. And know that what I'm about to say, don't think that this is the best thing for you. It's not. Not all of you, it isn't. But for me, if I had to only trade one setup and I had to wait for it, and it had to be there in the chart, or I did nothing, I would be trading the second stage distribution in my market maker sell model, or my second stage accumulation in my market maker buy model. And that literally is taught in the core concepts. Like it's there. I'm not going to say exactly that, but it's the second stage distribution of either reaccumulation for longs or redistribution for shorts. So I'm looking for a market that's really designed to go lower. Everything's in my favor, and it's a clear market maker pattern where it's going to go lower, it's going to go higher. And those moves are the quick, sudden runs, real quick. It's always going to be a low resistance liquidity run, which is why I'm saying that would be my, you know, drug of choice. If I'm going to be saying it like that, I'm going to get my high off of that one. And it happens every single week. And it sets up as a one shot, one kill. So it would allow me to do whatever I wanted to do with it. If I want to scalp it and get little pieces of it, or if I want to run the whole thing and get a whole month's worth of income, it can come from that one setup. So it can give me whatever I want from it. It could be the one setup for the week. It could be the one setup for the whole month. It could be a training exercise for me to, while it's running. That's my unicorn. That's my setup. That's the thing that if I had to only do one thing, it's that. But clearly you can see I have other things I can do. And what does that mean? I can do whatever the market's providing me an opportunity. And right now, one market might be choppy. If it's choppy, what does that mean? I got to do something else outside that one. Now, can I trade five handles in a choppy S&P market? Yes. But what happens if that choppiness is in dollar and you're a Forex trader? Your mind should jump right to the crosses that are non-dollar, because they're going to go crazy. And they had really wide runs and several handles, or I'm sorry, several hundred pips, and some of them moving a lot this week based on that consolidation in dollar. So that's the reason why it's important for you to understand that there are many ways to take setups out of the marketplace, but you also have to have a macro understanding of what causes these markets to have the disparity between them, because you need to have the disparity to have what? Movement. And without movement, we can't profit unless you're writing options, and we're not doing that here. So we need movement. As a intraday speculator, as a short-term trader, we have to have movement. So I'm teaching you to, number one, identify where that movement is going to be in the greatest probability. Is it going up or down? And then waiting time of day. What time of day should it do that? Well, that's the times I tell you to follow the marketplace. What happens on the day of the week that it's most likely to provide that? You're looking for higher medium impact news events, because that's where it's going to be highly manipulated. We're waiting for those opportunities where the market just wonderfully invites the retail trader to step into a snare. That's why we're waiting for those high impact or medium impact news driver days. Not FOMC, not CPI, but anything else. not non-farm payroll either, but any other event, medium or high impact, we love those days. We love those days because we know the retail trader is about to get sacrificed on the altar of trading. That's just the way it is. And the smart ones learn how to lose professionally the rest of their life. They manage losing. That's what consistently profitable trading is. Every profitable student, every profitable trader, every profitable speculator is a professional loser. They know when to take their losses because their winners are going to run. They're going to let them do that. The people that don't survive in this industry are the ones that are trying to be professional winners, and it's the only thing they expect. And by default, they lose and they end it for themselves. They really lose. They lose their account. They lose the ability to trade and speculate because they lose their mind. I'm hoping that in all this rambling tonight, I'm reaching some of you because the things I put you through in studying and observing things, I know what you want. You want me to tell you the trades that are moving and get you into it so you can make money because you think that's what you need. And I want you to be able to do this when I'm not here. And the only way that's going to happen is to teach you the proper way of doing it and also put you in the charts for homework. Your homework is every day back testing and looking. Back testing isn't necessarily, my version of back testing is not equivalent to what everybody else talks about. Backtesting is a casual view of previously traded price data that you can't participate in. Okay. Mock trading is going back to those moves and market replay, maybe a simulator, something like that. That's mock trading. There's a place for that. But my point of backtesting is there validity behind the setups I'm telling you to look for? And where does your eye gravitate to? So you're back testing the repeating phenomenon of a individual PD array. So you go through the process of going through old data and say, okay, I'm going to look for breakers. How many times does a breaker form? On what time frame over the course of the last 16 weeks, last 12 weeks? Okay. And you look at how much time it took for that market to deliver to a level that I teach you to look for. So if you're going short, you want to reach into a discount array, old low for sell side or old imbalance below whatever the equivalent would be for the range you're in, vice versa if you're going long. And you're going through and you're writing down a list of how many you see, how much movement there was, how much drawdown there was. And when you're doing that, what are you doing? You're drawing up an affinity for that pattern because you're spending time looking at it. Keep the focus on the things I'm telling you to do, which are boring in the beginning. But I promise you, if you go through the process of looking at old data, and once you find that thing that makes the most sense to you, what thing is that? It might be the fair value gap. It might be the breaker. It might be the optimal trade entry. It might be institutional order flow entry drill. It's whatever pattern that your personality aligns with. And you can make money with that one thing. Think, Bob Ross. He did most of his painting with the big brush, the small fan, and a little detail pen, not pen, but detailed brush. He had lots of brushes, but most of his work was done with those three particular brushes. Go to an art store, there's an arsenal of brushes. I couldn't tell you what the hell those things are for. I'm sure they're specialty for something, but imagine that brush is your PD array. It does a specific thing. You only need one thing to do a specific thing, which is what? Profit. You have to have a multiplier, a reason to get in. What's the catalyst that puts you into a trade? That's all you're looking for in the beginning. But you have to decide what that is. I can't push that on you. Like, I'm not manipulating any of you to do any one particular approach to trading. Notice that I haven't done that. And when you go through the core content, guess what it does? It gives you the opportunity to decide where you want to be. You want to be a long-term trader? Do you want to be a swing trader? A short-term trader? You're going to trade a daily range? Are you going to be a scalper? The decisions are up to you. And you have to bring that to this. You do. There's no tethering to me. Just this year. That's it. Once you get your wings, fly, baby. I want to see how high you can go. I can't wait to see you do it. But you've got to do the things I tell you to do. You have to. There's no way to do it other than that. You can't fumble your way through it. And it's going to require you to do work. And that means go through charts, see things in price action and data that you can't trade. You're not even pushing a button on demo. Nothing like that. Not even trade simulators. You have to go through the process of finding what it is that makes sense to you out of what I'm teaching as a PD array. That's your first step because I already taught you how to find the draw on liquidity, and I'm giving that to you all year long. That will happen by default. You'll learn that because you're being exposed to it. That's the only way you did it. That's what happens. That's why I taught paid mentorships where they had to spend the entire year with me. They will see, they saw, it's documented. Nobody can change it. Nobody can say it didn't happen. It year after year after year. Now you're seeing it on a minute by minute basis. But that PD array, that multiplier, that entry pattern, that concept of getting in, you need to decide what that is. You need to decide that. Nobody can make that decision for you because I can't make you see a mitigation block. I can't see how I could go into the charts and make you see a breaker if you just can't understand a run on liquidity and a shift in market structure. There's two minimal criteria that have to be there for that to be a breaker. And if you don't understand liquidity or where people put trading stop losses and how they might look at the marketplace as a potential breakout, you won't understand a breaker. You won't understand it. You can see me pointing to it, but it means nothing to you. Why? Because you haven't studied old data enough to say, oh, yeah, look what happens there. And you have to look at the chart and question, before this move happened, who was long and who was short? And if they were long or short, where was their stop loss at? And then reverse engineer all the price movements, because that's what I did, folks. And you won't be able to do that unless you've done all the back testing, which is simply just looking at old moves and studying them. You're not trying to trade them. You're just observing how often does it form, how quickly does it move into profit, and how much drawdown would it be. And you're logging that and you're putting down, okay, this market on this date, it did this. It moved this much to profitability. This is how much it had in drawdown, and this is how much time it took to trade. And then you're going to get a running total or an average of how many points or pips, whatever market you're looking at, on average, collectively, cumulatively, you'll see that. And then you'll also see what's your maximum losing trade that you saw in that sample set, and what was your maximum profit trade. Throw both of them out, then average what you have there. And that'll give you a pretty good idea as a baseline if that was going to be your model. This is what you, because you can't say that would have been my best trade. I would have got that. Take that out. And your worst trade, what was potentially your worst trade, you probably would have not had your entire stock taken out because you could be doing partials. So you got to take both those numbers out. Don't even factor them in. I'm not trading to try to save face on live streams. Okay. I'm not doing that. I'm trying to take measured, calculated risks. And if the trade is going to go bad, generally, most times I'm going to see it's probably not going to be there. And I start doing that too. The 3-minute rule of it's got to start talking to me right now and be in my favor, or I'm going to start taking some of the trade off or close it all away. I have tools for all those. And then eventually replacing what was required in maybe 1 or 2 jobs to get your income covered. Now you can get it entirely from your trading. So now you've doubled your income. So the next step is to triple your income and save up $200,000 of your own money, not $200,000 in funded account, $200,000 of your own money, and then have a respectable amount of money for trading in yourself, your own money. And you can hold on to these funded accounts if they're still allowing that to be a thing. But you have to have money in the bank before you consider leaving your job. Just because you made a lot of money in your funded account and you had a 6-figure withdrawal, that's not an invitation to quit, because $100,000 is nothing. Like, that's nothing money. For some of you that find it as a first big windfall victory, it's life-changing for you, but it's not going to last forever. I'm calling shots. I'm calling where the market's going to go. All you have to do is study it and then let the process of being there, observing it, even if it's in hindsight, if you can't be there when I'm doing it live, watch the recordings or add the tweets to your chart afterwards and see it. Your eye will be trained in observing it. And because you're doing it, back test, study, look for the things I'm telling you to look for in lectures, and do that while we're doing this tape reading. That's how we're spending the first 2 months. We already got through pretty much this month so far. Just a little bit more time, and then we'll be into what would be considered month 2. In month 3, you're pushing buttons. Okay, I'm going to put you in the markets. I'm going to tell you, do this right now and start tracking how much time. And you're all going to have different fills. You're all going to break the rules. You're not going to put your stop loss in because you're going to be fearful that you're going to get stopped out. Like, I'm in the room looking at you, and you're afraid, or you're afraid that other people in this community are going to see you do it wrong. And I want you to press into that and be interactive with me. Share that experience publicly when I ask you all to do it. I'm not making money on the tweet replies. Okay. So it's not traffic. I'm not monetized in Twitter. I'm doing it so that way we're seeing and hearing each other just like a text message. Like if I was your brother, if I was your dad or a relative, I want to send you a message, like I had your phone number or whatever. I'm treating that medium the same way. I'm looking out for you. There's just a lot of you. And every time I'm tweeting to you, it's the equivalent of me texting a family member saying, "Hey, here's my here's my focus right now. I want you to know about this." So it's not a signal service, but it's like a handshake. I'm grabbing you, pulling your attention to something right then and there, and then you have to engage